I actually started in biophysics, but I had some difficulty with the randomness that modern physics obliges that I accept. If I had the choice, I would have sided with Albert Einstein, who, when asked why he could not accept Niels Bohr's Copenhagen interpretation of quantum mechanics, famously answered he did not believe that God played dice with the universe. At that point, I needed certitude. I was looking for sustainability. I was looking for replicability. So I started studying power. I studied the power of action, politics. I studied the power of thought, philosophy. And I ultimately gravitated to the classical Greeks. I told my students it was because of the Vietnam War. And at the time, I didn't really trust anyone who was born after Aristotle. These days, I still teach Plato and Aristotle upon occasion to renew my roots, but everything else I do, write, study, consult, and advise is in international oil. And in the political and economic and financial and market risk elements that attend to it. And I've learned something. I've learned it from science. I've learned it from politics. I've learned it from markets. Sustainable and significant change is a result of necessity. It's not a result of abstract choice. Societies and markets have built-in, ingrained, inertial structures resisting change. So if the change takes place anyway, the status quo is clearly becoming untenable. And that produces initially two observations. First, all societies, all markets wish to reach sustainability, equilibrium, balance. When that takes place, where that takes place, how much it costs, those are unknown questions. Secondly, there's a tremendous amount of unpredictability in this entire exercise. But when you do it in a democracy, it tends to take place in a very unusual circumstance. And for this, I go back to the classical Greeks. If you go to the heyday of Athenian culture, which was about 35 to 40 years in length, this is about the time in which you have the rise of philosophy and you have the funeral oration of Pericles. They taught us something. They taught us that people do not enter into society to live, to exist, to survive. People enter into societies to live well, to do the great deeds, to do the ongoing, recurring deeds, to do the great human actions. And in these sorts of circumstances, we tend to recognize that you need a particular place. And the Greeks gave it to us. It was called the public space. Now, this was not the public place where you did the private thing. This was not the agora. This was not the marketplace. This was not commerce. For those of you who saw the debate last evening, this is when Joe the plumber drops his wrench and picks up the mantelpiece of being Joe the citizen, where for a brief moment the personal interest go to the back burner and the genuine concern about the public good takes over. It is where the fellow who has worked all day long, who's exhausted, he nonetheless goes to a public meeting, he rises to give his views of the issues and everybody's watching him. You can tell that his fingernails are dirty, he's a common worker, and there you have it, my all-time favorite American political portrait from a cover of the Saturday Evening Post, the average American saying what he needs to say in the public space. Well, this becomes extremely important in the current situation because that public space is now undergoing a considerable amount of change. It's happening. You may have noticed it. The first elements are there for everyone to see in the stock market. But it's only beginning. And this circumstance is going to be becoming more and more evident. What I'd like to do today very briefly is to talk about how this is unfolding in the oil sector, in the energy sector, what the problems are that are developing here and what it is we're supposed to do about it. Let me give you the bottom line right up front. The bottom line is, I believe we have about 30 years left of a sustainable crude oil-based economy. This 30-year period requires that we do something, and we do something quick. There are two alternative tracks that we have to use simultaneously. The first one is we need alternative energy. That's a no-brainer. Even political candidates have figured that one out. But despite the developments that have taken place, we're well 10 to 15 years from any significant development in alternative energy, which means we need the second stage. And the second track is we need sufficient crude oil at sustainable volumes at affordable prices. And we need to do both of these together. I ask that you conceive of the following, and I need two hands for this, but think of three concentric circles, because that's basically what I'm going to be talking about here. The smallest of the circles deals with the supply and demand, the market considerations, sustainability, prices and cost, availability, etc. These are the normal things we think of when we talk about a product, especially energy. The bigger one deals with the overall finance picture. What do the credit markets look like? How are you going to fund these contracts? How do we determine the overall paper structures that are going to be used so that the energy can continue to be moving from those who produce it to those who need it? And then the third and broadest is the geopolitical impact. This is clearly the most exogenous of any of the elements that impacts the oil market. This deals with a lot of things from a lot of different areas over which you have very little control. But disconcertingly, something has occurred recently which I find to be very dangerous. And you've probably even noticed this. Energy issues are now becoming political issues. They're becoming weapons in nations' arsenals of foreign policy. And when that takes place, the risk element increases significantly. Well, let's go back to the first one. Talk about the supply and demand situation. What does it look like? Currently, we are in a declining demand market because we have the sort of credit crunch that we haven't seen since the 1930s. Once it stabilizes, and it will, or we're all going to stop breathing, I mean, it's going to stabilize, we will see the demand come back. Now, what you have to recognize is the demand is being generated, and the demand will come back from non-OECD countries. The new demand spikes are not coming from the developed countries. The new demand spikes are coming from parts of the world that are not adequately contained in the figures we normally generate. It's certainly coming from the new industrial countries, such as China or India, the renewal of industry in East Asia. It's also coming from increasing demand within the nations producing the oil themselves. Saudi Arabia, OPEC, Russia, Venezuela. And then finally, the biggest demand spikes are taking place in those parts of the world which until recently weren't even on our charts. Anybody have any idea which part of the world now has the greatest accelerating increased need for oil? No, but you're not far off. West Africa. And nobody really deals with West African figures these days. The demand coming on board, therefore, is demand that will quickly outstrip available supply, period. Which leads us to the second point. What does the supply look like? We're leveling off in terms of available supply. Now, you've got to be very careful how you look at these statistics. What we need to look at is the available supply of oil that can be extractable at market prices in the current commercial market. There's a considerable amount of oil reserves out there that companies know they have that will never be extracted because it's already too expensive to do so. I'll give you a very simple example. In the first week of July, we reached $147.27 a barrel for crude oil. At the time, we had over 360,000 capped orphan oil wells in West Texas. Even at $147 a barrel, it was too expensive to extract those reserves. So what we need to look at is extractable reserves, those that can be reserved at commercial prices. The IEA, the International Energy Agency, a division of the UN, puts out regular figures. Their most recent figures came out in July. For the past 3 years, the top 10 producing oil companies in the world have replaced 75% of the extractable reserves they've taken out of the ground. We're losing in terms of providing sufficient supply to meet the demand. The new oil that is coming online, smaller fields, inferior product, every conceivable geological difficulty. It's coming from areas of the world in which you have sustained political and economic difficulties and where you need an incredible amount of infrastructure. It's out in the middle of nowhere. There are no roads, there's no power, there's no communications, there's certainly no pipelines. Over 85% of everything that's spent on an oil well these days is spent before you get a single drop of oil out of the ground. So we have a number of companies that have been committing a considerable amount of money, and they started when it was $147 a barrel. When I left a couple of hours ago, it was barely $70 a barrel. We've declined over 50% in the last couple of months. These companies are already developing fields that are guaranteed losers. The end result is going to be that our supply side is going to be even more adversely impacted. Now, we've seen a very interesting development in the overall structure of the market itself. Traditionally, if you were in the oil market, you wanted to control either process or product. You wanted to own the oil well, you wanted to own the oil refinery, or you wanted to own the actual oil. In other words, you wanted to own wet barrels, actual barrels of finished product. Today, however, all the money is being moved into controlling access and availability. These are paper barrels. I'd like to control your access to the barrel, but I really don't need the oil. What does that mean? As markets go up and down, these barrels get traded quicker. The market becomes incredibly more volatile, and essentially that makes the prices more difficult to determine. Well, secondly, talk about the second sphere, namely finance. Here we're dealing with what directly may be the most serious problem for the American economy. After what we affectionately call Bretton Woods II in 1974, where the Saudis agreed to take dollars for oil consignments, the rest of OPEC followed suit, and virtually all of the other producers in the world did as well, so that you denominate international oil contracts in US dollars, regardless of what the local currencies happen to be. This provided considerable seigniorage to the American currency. Seigniorage is the advantage when other people have to use your money. This became known as petrodollars. Dollars had to be exported all over the world to subsidize and finance these contracts. Now, since that money is going abroad and is remaining in foreign banks, it's not inflationary. This is an interest-free loan to the U.S. economy. Much that would come back, especially from the Saudis, would be invested in either sovereign or corporate debt. To the extent that that's not in the market and circulating, it's also not inflationary. And this is essentially how we were able to subsidize expanding budget deficits without having any inflation. This is coming to a quick end. As you may have noticed, the dollar is declining in its overall exchange value against other currencies. We have rapid movements in the rest of the world to set up new oil exchanges, to denominate contracts in currencies other than dollars. We now have a market that's built in this discount. If you take a look at the last 3 years, the average oil contracts in US dollars have increased by 87%. The average contracts in euros have increased 71%. The market has already factored in the relative strength of the euro and the relative decline in the value of the dollar. We have other exchanges being set up. There's a new exchange in St. Petersburg, Russia, where you buy and sell oil and it's denominated in rubles. You have the Kish Island exchange in Iran, where you can use any currency other than rubles. Actually, I think you could buy Iranian oil right now for box tops, but you can't use dollars. We have Mr. Chavez and Mr. Morales in Central America that are advancing a eurozone for oil and gas. For Mr. Chavez, that artificially inflates the value of the bolivar, his own currency. But we're rapidly seeing the rise of regional currencies. Every time these contracts emerge, and they're emerging with greater frequency through the Dubai exchange, it ends up allowing more petrodollars to come back to the United States because it isn't necessary, and that will be fueling inflation. We have a stretch right now in the foreign oil, in the future oil markets. We've already had this credit crunch. Everybody knows about it. The other shoe that's about to fall
is the oil traders can't meet their overall daily margin requirements. Now, what they used to do in those situations when the price would go down, they would go and get a short-term bridge loan. Well, there's no credit there. We have consignments of oil that are expiring now well before the contract expires. It means that shortages will intensify in the international market, and it also means that we'll have oil out of the ground with no customer to send it to, which is an extremely inefficient situation. We've been inventing new exotic paper to deal with this. We have new derivatives to try to cover up these holes and the difficulties in the oil market. The end result is, as with any derivatives, you don't really know what the value of them are. It's sort of like betting on a football game and just betting on the point spread. You don't particularly care who wins. You just want to figure out how many overall points are being scored. Same sort of thing here. And these derivatives are creating greater difficulties in the markets as well. Well, I'm just going to forget about the geopolitical. We could talk about that for several days. Let me simply conclude here, this is becoming less and less predictable, and the risk is increasing. Look, we have less than 5% of the world's population. We use 26% of the energy. Until recently, as the 1,600-pound gorilla in the room, we could dictate the prices by being the primary end user. We've lost that leverage. And as we lose that leverage, other nations are profiting from that politically. What are we going to see in the near term? I'm talking about the next 3 years. We're going to see market equilibrium requiring price spikes. We're going to have shortages. We will have resource conflicts. Dr. Noel Brown yesterday, I think, was correct. The first resource conflicts we're likely to have are over water. But those in energy will be coming quickly thereafter. We'll have rising levels of internecine struggle. What's occurring in the Niger Delta in Nigeria is the first wave of what's coming in the future. Declining world prospects. Let me give you a couple of really disturbing situations. In 1974, when we had an oil boycott, the Nixon administration seriously considered nationalizing Exxon because they believed that Exxon was making an unsavory profit in a difficult situation. Well, nobody seriously considered nationalizing Exxon in 1974. We've already decided over the last 2 weeks we're going to start nationalizing banks in the United States. So we've already gone over that issue. Nationalizing oil companies may not be such an unsavory prospect. Secondly, and most disturbing, we keep revising this in Washington. In 1977, a plan was set up. That plan draws a rectangle. That rectangle begins in Basra in southern Iraq. It goes down the western portion of Iran, the eastern portion of Saudi Arabia, and it ends in the United Arab Emirates. That rectangle is set up for American military occupation to keep the oil flowing. As we get further into the situation with declining prospects in crude oil and increasing difficulties in the market, that becomes a more likely prospect. What do we do about this? Well, we got the two alternatives, obviously, the two tracks. Number one, we need to get additional crude oil, but we need to get it in a responsible way. Now, there are several ways in which we can do this. There's unconventional crude oil out there. There's tight gas plays. There's coal bed methane. There's oil sands. There's bitumen. All of these are available in sufficient supply, but they generate more expensive costs. But that's number one. Number two, rather than trying to get additional fields out there, we have technology coming online which will allow us to keep the existing fields open longer, which is a far more efficient situation. Not only that, some of the technology I've seen actually benefits the environment. It tends to reverse some of the damage that's been done by earlier oil and natural gas. That's an even better benefit. In the second approach, with alternative energy, we need to do this. It's going to be the most soul-wrenching, difficult, expensive thing America has ever done. We're going to have to redesign our infrastructure, and we don't have a clue how we're going to do this. Once it's finished, we're going to have an overall matrix in which there are far more sources of energy than there are now. But we are not quite certain how that's going to take place. One of the difficulties we have is this, and if I had more time, I'd talk about Steve's pond scum. There are a number of advantages here. Americans are very good at this. Give us a practical problem and we'll figure out how to solve it, even if it looks a bit unusual. we have something that used to be called EPR, or energy profit ratio. And what that simply says is, how much energy do we have to expend to get energy out? If you have to spend 1 barrel of oil equivalent to get 1 barrel out, in other words, if your ratio is 1 or less than 1, it's of no advantage whatsoever. American crude oil, which is very inefficient, has an EPR of 8. Saudi crude has an EPR of 22. The best alternative energy we've come up with has an EPR of 1.67. We have to commit 2 barrels of energy for every 3 barrels of energy we get out. And the other problem is, you simply don't know what's going to happen once you bring it out of the lab and stick it in the backyard. Once you try to scale it, it simply collapses. My favorite example is ethanol. I think ultimately ethanol is going to produce about 8% of our energy needs in this overall mix. But for a while, you may recall, ethanol was going to be our savior. If half the automobiles in the United States were to move from gasoline to ethanol, we would need 2.2 times the arable land in the United States to grow only corn, and corn only for fuel. And what happens to everything else that needs corn? These are the kinds of difficulties that we're going to have to deal with. We need a national energy policy. We need one with teeth. We need one that doesn't require that regions fight each other for what's available. That's exactly what's happening now, especially here. The Northeast of the United States has been the worst hit by the energy prospects. It's cost us jobs, it's cost us investment, it's cost us expansion. We've seen outsourcing, but the outsourcing isn't simply to places like China and India. The outsourcing is to places like North Carolina and Texas. This is an internal fight that we've had to go through for the last several years. We need a national energy policy, and the people who have looked at this recognize you've got to bite the bullet. This will hurt somebody, and we've got to be prepared for that. The longer we wait, the worse off we're going to be. Now, this is a national security issue, and it doesn't simply deal with borders. A national security issue in the United States is being able to preserve the American dream. The guy wants to keep his job. He wants his house not to be foreclosed. He needs to feed the kids. He needs to have some prospect of sending them off to school. And he needs to be able to do that in relative security. That's national security. It's no longer a question of whether you can afford an SUV. The question now is, when you get into your SUV, do you still have a job to drive to? This situation has gone far beyond the pump. Let me end with this. It's the old sort of question we always ask. Do we make history, or does history make us? One of the big artificial things we do in the study of history is that we regard ourselves as being passive observers as the parade goes by. It never works that way, especially in crises like these, and especially in the public space we've set up in American democracy. We are participants. We either choose to do it, or we get dragged in kicking and screaming, but it's going to happen sooner or later. This situation has to be dealt with now. It has to be dealt with a social consensus, because the problem is simply going to be worse later. Thank you very much.